Thanks, George, and thanks everybody for coming today. It has been an interesting time in the world vegetable oil markets over the last several months, and certainly over the last 10 weeks for sure. Soybean oil futures have moved either higher or lower by a cent every week in 8 of the last 10 weeks. And just to give you a little bit of scale there, the typical standard deviation for price moves in soybean oil is about 2 cents a month. So volatility is high, and there's several reasons for that. Primarily, there's been a huge rally in world vegetable oil prices due to shortages in China, which has driven them to buy more vegetable oil and different kinds of vegetable oil than they typically do. And the second primary driver has been the lingering impacts of the coronavirus and the changes that that's had on vegetable oil demand, and also the supply of competing fats and oils, and to a lesser extent, some other vegetable oils. So just getting into some of what's happened and why we are where we are. This is a slide that we used in our last webinar, and it just shows the changes in consumer spending on food at home and away from home. And as you can see, there was a huge drop initially in away from home spending, but there was a similarly relatively large increase in at-home spending as people stocked up ahead of feared lockdowns, and that pattern has come back a bit, but away from home spending is not completely recovered. However, total spending on food has recovered and has grown slightly over the summer. Going forward, there's some question about whether the return of cold weather in the north and the resurgence of the coronavirus will drive spending away from home back down towards those spring lows. Today, I think New York said that they're probably going to close in-restaurant dining, and I would expect that there probably will be other areas in the country that follow that same suit. And so spending away from home is likely to decline. The question will be, can spending at home keep pace with the decline in away from home spending? Probably not. You tend to spend a little bit less when you eat at home than you do if you eat out. But this has some impact on the availability of some of the other vegetable oils, and certainly for the biofuel people, the availability of stuff like used cooking oil drops off pretty dramatically when the restaurants close. At the same time, we've had really strong demand from biodiesel producers, again, in part because of the coronavirus. Initially, we had a really sharp decline in ethanol production, which reduced distillers' corn oil output. We also had a decline in slaughter rates, which reduced the availability of stuff like tallow and choice white grease. That has come back. It hasn't come back quite as far as before. It hasn't come back to the level it was at before the pandemic, and it may not. Particularly ethanol demand probably remains below where we were before the pandemic due to the adoption of work from home. It looks like maybe about a 10% reduction going forward in ethanol demand. Now, there are potential offsets to that. So if the US can export more ethanol, then potentially production could rise back to those levels. But right now, the way that we're looking at it is we are just assuming that ethanol production going forward is probably about 10% below where it was pre-pandemic. And that's going to limit the supply of distillers corn oil. And that then leaves more feedstock demand that needs to be met by essentially soybean oil. And what you've seen is that soybean oil's percentage of the total feedstock mix has risen to historically high levels, and we expect that to continue. On our chart here, this September number might be a bit optimistic, kind of given where we were. But if you look at the seasonal trend in soybean oil usage, that's kind of where we came out. Either way, we don't expect that soybean oil's percentage of total feedstocks is going to go right back down to where we were before the pandemic. And that little bit of marginal demand combined with relatively strong non-biofuel demand and strong export demand has tightened up the market and contributed to the sharp rally in soybean oil futures. So this has been the really big driver in world vegetable oil prices. There was flooding in China this summer that ruined part of their rapeseed crop. And they also there's some strong political tension between China and Canada, which is where China typically imported a lot of canola from. And so they haven't completely shut off canola or canola oil imports from Canada, but they have significantly reduced the volumes of canola seed and oil that they're taking from Canada. That's left a hole in their vegetable oil balance sheet and their rapeseed oil balance sheet, and you can see the impact of that on the prices. You can also see here, this is the price from Canada, and those prices haven't kept pace with the increase in China simply because that market has been shut off from them. Whether this will continue into the next year or not will depend obviously partly on the weather in China during the next growing season, but also in other areas of the world. If China can import enough vegetable oil and enough different kinds of vegetable oil to ultimately fill this gap, we would expect that this pressure on world vegetable oil prices would ultimately subside. The question is, will it subside soon enough to allow prices to come down before we get sort of a surge in biofuel demand in the US that we expect probably will drive prices substantially higher in 2021 and 2022. So this is that demand. This is the primary driver and probably will be the primary driver of vegetable oil, fats, and grease prices over the next 2 years. You can see we're expecting a tripling of renewable diesel production capacity between essentially now and the end of 2022. And all of that production capacity is going to need feedstocks. Of course, the favored feedstocks are low CI feedstocks because of the way that they're treated under state level renewable fuel programs. But we don't kill pigs or cows for tallow or choice white grease. And so that supply is essentially fixed based on the demand for meat. And this demand is coming, and whether the supply is there or not. And so that kind of leaves a big gap that's going to need to be filled by vegetable oils, primarily soybean oil, especially in 2021. We think that there will be a pathway approved for canola oil before the end of 2022 and maybe even early in 2022 or late in 2021. And so that'll help somewhat, but nevertheless, there's going to be a big gap in the feedstock demand based on this huge expansion in capacity and the availability of low CI feedstocks. If the coronavirus pandemic continues to limit eating away from home, then the supply of UCO is also going to be significantly below where it was before the pandemic. And that's just more soybean oil that's going to need to go into renewable diesel production. We also have an expansion in co-processing capacity. Now, this is not nearly the size of the expansion in renewable diesel, but given how tight we expect everything to be, every little bit is going to be significant for prices and significant for the demand. So co-processing also going up a little bit quicker than renewable diesel, or we should realize whether these projects are actually up and running or whether they're not up and running a little bit sooner than we are going to in renewable diesel, and there aren't as many to keep track of either. So this will be a little bit easier to monitor. But again, every little bit of increase in feedstock demand is going to be important and a significant driver of prices going forward. And so this is what it looks like just in terms of total demand for feedstocks. You can see that biodiesel production we expect to kind of tail off into 2022 as renewable diesel production comes on. The increase in renewable diesel production is probably going to pressure the margins for biodiesel producers and cause some rationalization in that industry. Integrated producers are probably going to be okay, but smaller non-integrated producers, especially those that can't ship into the West Coast markets where there are additional credits available, are probably going to need to shut down or find export markets or do something to be able to stay in business. Right now, we expect that their production will fall off, and this chart also gives you some idea about the relative expansions in renewable diesel and co-processing and the impact that they're going to have on the feedstock market. You can see the renewable diesel expansion is much more significant than the co-processing expansion. So what does that really mean for non-biofuel vegetable oil usage? You can see where we were sort of just before the pandemic, and it has been relatively strong through the summer and into the early fall. During the spring quarter, per capita usage of vegetable oil fell to the lowest level since 2012. And we expect that this growth in demand from biofuel producers and also relatively strong export demand is going to limit non-biofuel usage going forward. So you can see that we've got 2021 non-biofuel demand cut already well below the level that we saw during the pandemic. Now, those guys aren't going to go easy into the night. And so it's really going to be a situation where basis levels are probably going to rise pretty sharply, and prices are probably going to need to rise pretty sharply to get them to find alternatives or to ration the demand. One thing I would note is that we've had a big expansion in U.S. soybean crushing capacity. But even with that, we think that things are going to remain relatively tight. And so there's not really, it becomes very tough to find a spot where you can expand supply sufficiently to meet all of the demand that you would normally want to have in these markets. And given the profitability of renewable diesel production, particularly for producers that can ship into the West Coast markets, it's going to be very, very tough for other sources of demand to compete with those guys. And so what you're left to do is cut exports and cut non-biofuel demand until you get a better sense of exactly how this increase in renewable demand from renewable diesel producers is going to impact the market. For exports, export demand was strong last year. I think probably most analysts started off 2019-20 with U.S. exports at 2 billion pounds or maybe a little bit less, and we ended up at about 2.7, 2.8 billion pounds. This year, you can see commitments are already running above where we were last year. One of the big drivers behind this is the spread between soybean oil and palm oil. That spread typically is in the 4 to 5 cent range, with soybean oil being 4 or 5 cents more expensive than palm oil. And right now, if you look at the July futures contracts, the spread is close to parity. And at that level, importing countries will prefer to buy soybean oil over palm oil. You saw this in last week's export sales data when India bought 30,000 tons of soybean oil from the US. That may not sound like a lot, but India over the past year, shipments to India have averaged about 14 tons a month. And so at 30,000 pounds, that should, in theory and in regular times, that would be enough to last them for years and years and years. But given a relatively tight stocks of palm oil in Malaysia, and in the outlook for those stocks to remain relatively tight, and the price differential at such a narrow level that they won't be the only ones that are going to switch from palm oil to soybean oil. And that's important because it provides another amount of demand that is going to compete for what are going to be relatively limited supplies. It will be really interesting over the course of the year to see whether commitments continue to trend above where we were last year, or whether we hit a spot and prices get high enough that importers just cut demand, as opposed to switching from soybean oil to palm oil, or exactly how this plays out. Right now, we are forecasting that we're going to be around where we were last year in terms of exports, but then going forward, we're going to have to start to cut soybean oil exports to meet the demand. So I said, we've had this expansion in crush, and sure enough, in the October NOPA report, we got record October crush for any month. And that would be fantastic if it had occurred, if all of this was occurring sort of a couple of years ago when the soybean carryout was nearly 1 billion bushels. But this year, soybean carryout is going to fall down to pipeline levels. So you can pick what that is, and you can pick what your carryout is, whether it's 135 or 125 or 145, really doesn't matter. All that tells you is that the ability to substantially increase crush from current expectations, which are 2.19, 2.18 billion bushels, something like that, is very, very limited. As you can see, we actually increased our crush forecast a little bit after the NOPA report, but it's very tough to increase it further. And you can see what the trend looks like. It looks like October is the peak, which is kind of typically the seasonal pattern. But given where we are, especially with soybean oil demand, we don't necessarily think that crush is going to come riding to the rescue with a bunch of additional soybean oil supplies that can be made available to the market. Now, for 21-22, we actually are projecting crush of 2.3 billion bushels. Whether that's actually doable or not remains to be seen. One, we've got to grow a crop so that we have enough soybeans to crush, but two, whether the capacity will really be there to be able to crush that. Many soybeans is a question right now. Even if we do that, the continued growth in biofuel production is going to continue to pressure the crush. And at some point, I would assume that oil share is going to have to rise to a level where crushers are actually crushing for soybean oil and not based on soybean meal demand. That has to be greater, and probably significantly greater than 50%, because of the difference in how long you can store soybean oil versus soybean meal. Essentially, soybean meal has a relatively short shelf life. So if you're right now, they're crushing to meet soybean meal demand. If they have too much oil, they can kind of store it and deal with it later. If you switch that around and you start to crush for soybean oil, you have to figure out something to do with the demand, or with the soybean meal. And that says that soybean meal prices may head significantly lower if there's a downtick in domestic meal demand. and B, that soybean oil prices potentially could have to rise well above where you would think they would have to rise just in order to incentivize crushers to crush enough soybeans to provide the supply for biofuel demand. So this is what the total vegetable oil feedstock and supply and demand looks like in the U.S. There's a couple things that to note here. One is the decrease in exports and non-biodiesel use and exports. This is going to be relatively tough to accomplish for all of the reasons that we've been talking about. If we don't get a big increase in palm oil production this year, then and that spread remains relatively narrow, importing countries will prefer to import soybean oil rather than palm oil. That makes it more difficult. And for non-biofuel users, it it's not necessarily a situation where, okay, we are out of soybean oil, we can switch to canola oil or we can switch to a different oil, because all of those oils are going to be relatively short too. And so this just adds to getting this accomplished is going to be a monumental task. And I think it's going to require prices that are substantially higher than I think we can imagine makes sense right now, just to again incentivize those crushers to provide sufficient supplies and incentivize farmers to grow sufficient a large enough crop to have the soybeans to crush. This is what the fats and grease supply and demand looks like in the US, and it's kind of the same theme. Non-biofuel use ticks down, exports tick down. Stocks we have essentially staying the same, but that's primarily just because the stocks number is a picture at one point in time. And some level of the stocks, particularly in fats and greases, are a lot of those stocks are sort of in transit or kind of work in process kind of stuff. And so they're already at relatively low levels. We don't have a lot of fats and grease stocks sitting around anywhere at any given time. So the decline, the lack of a decline in stocks here isn't indicative of, oh, we have so much of this stuff that stocks are going to be the same. It's just a function of, it's much more a function of how we actually count fats and greases, grease stocks than anything else. All right, so to switch a little bit just from the US to outside of the US, this is what we're projecting for biodiesel production outside of the United States. You can see that for 21-22 biodiesel production, we're expecting to grow, but at a much slower pace. Really, there are kind of a couple of different sections of biodiesel production outside of the US. You have countries like Argentina and Malaysia that primarily produce biodiesel to export and have modest domestic demand. And then you have countries like Europe that consume a lot, produce a lot, and consume a lot. And then you have countries like China. China theoretically could be a big source of additional biodiesel production, but given the adoption of electrical vehicles in China, I think that probably production in China remains relatively muted. One of the big risks to this forecast, I think, is the mandates in Indonesia and Malaysia. Given the spread between palm oil prices and gas oil prices, right now it's costing those countries a lot of money to implement their mandates. On Monday, the Indonesian government kind of said, yeah, we may wait to implement the B40 mandate. That's not surprising. Indonesia kind of really went back and forth for several years before implementing their current mandate. And so at these prices for palm oil, I wouldn't be surprised if that gets pushed out. Malaysia has been a little bit more steadfast in their adoption of the new mandate, but we'll see when push comes to shove if that actually happens. The mandates in those countries are really geared towards raising domestic consumption of palm oil and raising palm oil prices for palm oil producers. And with palm oil trading around 3,300 ringgit, there's not necessarily that the need to do that. And also there's probably a political penalty for politicians that want to implement these mandates because biodiesel is more expensive than regular diesel for everyday users of fuel. And so from that perspective, there may be some downside risk to this forecast, but to the extent that it would be downside in given the relatively modest domestic use in those countries, the downside is probably relatively limited. So this is what that production translates into in terms of feedstock demand. You can see soybean oil feedstock demand is important and significant, but it's relatively flat in terms of growth. Same with canola oil. Where you see the growth is really in used cooking oil and in animal fats, certainly from relatively low levels, but given the adoption in Europe of incentives for low CI feedstocks, we think that probably the growth in feedstock demand in Europe will be in those areas. And that's important for the US market because to the extent that on some level, to meet all of the demand, all of the growth in demand in the US, we'll need to import stuff that may actually limit the amount that's available for US biofuel producers to import. All right, so what does this mean for prices, at least over the next year? Right now, you can see we're trading at a relatively high price, and our error bars, our trading range for the December contract is the widest trading range I think I've ever published because of this volatility. It gets narrower, and we think that prices remain around this range, maybe head up towards 40. The decline here over the spring and the summer is really a function of a decline in soybean prices. Right now, I think we have to assume that the Brazilian crop may not be everything that it could be, but it may not be a disaster either. And so if that happens, and then you get a big increase in acreage in the US, then the soybean price rally will probably come to an end, and we'll probably trade back towards $10 or maybe even below $10 a bushel. And then in that environment, then it just tends to drag soybean oil down with it. There are times when soybean oil trades independently of soybeans, and ultimately this might be one of those times. But I think there's probably a little bit more downside risk for the summer month contracts than there is for the current contracts, and then certainly for the contracts beyond the next harvest. Now, I go back and forth on this chart all the time. There's part of me that just wants to draw a line from the bottom left up to the right. And I think that there is a small probability that that's actually what we will realize in the coming year. Certainly, I think over the next 2 years, like I said, I think that by the end of 2022, prices could be at levels that are a little bit hard to contemplate right now. I'm not saying necessarily that we'll see prices back where we saw them during the initial sort of excitement about biodiesel production, when prices shot up and the oil share traded above 50% briefly. But certainly we could see prices well over 40 cents and maybe substantially over 40 cents, maybe 50, 60 cents by the end of 2022. For palm oil is in a situation where stocks are relatively tight right now. But I think the combination of potential reduction in the mandates, and then two, stocks are a little bit tight, a little bit because of some restrictions that they've put in place for to try to contain the coronavirus, and also a little bit because conditions were a little bit dry in Malaysia and some of the growing areas over the summer. But I always tell people there's no better way to get fruit trees to yield than to stress them a little bit and then give them lots of rain. And that's what La Nina does, is it implies above normal rainfall in Indonesia and Malaysia. And so while I think stocks probably remain tight through 2021, I think by the time we get to the seasonal ebb in production this spring and then start to produce in the summer, production could be well above expectations, and we may be raising our production forecast for palm oil. And I think that will tend to weigh on palm oil prices. This weakness is also contributing to the potential weakness for soybean oil prices in the summer. And then for canola oil, there's a couple things I'll say about this. So one, the spread between canola oil and palm and soybean oil, we're projecting to remain kind of steady. The spread between this series and soybean oil futures is about 9 cents historically, and that's what we're projecting going forward. There's some risk to that. The biggest risk is that we're projecting Canadian crush to match last year's record level. Export demand has been relatively strong in the first couple of months of the marketing year, and so if exports outcompete crushers, canola oil supplies might be limited, and in that case, the spread would probably widen. Also, if we do get if the EPA does approve a pathway for renewable diesel, especially in 2021, then that spread could actually widen out a bit, at least over a short period. And then depending on the amount of demand that canola oil garners from the renewable diesel folks, it could widen out for quite a bit longer. All right, that's the end. And with that, I'll open it up to questions.
All right, thanks, Tori. We have just a few questions so far. If you have questions, go ahead and drop them in the Q&A section of Zoom. There's a Q&A button down there. Drop it there, and we'll get to them as they pop up. So just starting this off, is there an increase in co-processing just one big expansion that we know about, or is it several projects?
It's actually a couple of projects. They are, I think of them as relatively large. They're not as big as some of the renewable diesel plants, but they're a lot bigger than a lot of the sort of the biodiesel plants. So I think they're in the around 100 million gallon a year range. But there's two existing plants right now, and then we're expecting 2 more to come online.
Okay. Tori, when it comes to La Nina, in your projections, should it be understood that you see it as weak and short?
Yeah, I think that it probably will be over by next spring at the latest, maybe even earlier than that. If you look at the impact of La Nina on South American yields, there's definitely an impact there. But if you take the range of outcomes in La Nina years over the past 20 years or so, that range of outcomes essentially implies a Brazilian crop that ranges from 125 million tons to like 143 million tons, with obviously 125 being the most significant. And I think the soybean market will have a problem, or soybean prices will remain really well supported if we are below 130, 132, somewhere in there. And so even if the La Nina is a little bit stronger and maybe lasts a little bit longer, I think it's tough for I think it's tough for production to fall enough for soybean prices to really have, say, a ton of upside from here. Like $12, I can see that. Calls for $14. That seems a little extreme to me. And then on top of that, another thing that sort of moderates my excitement for soybean oil or soybean futures is the fact that We just grew a crop in the United States that was more than 50 bushels an acre on average in the driest September that I can remember. And soybean plants, you can have soybean plants that look terrible. So as long as you keep them alive until you get to pod filling, that's all that really matters. You can have soybean plants that look great, like you had this summer. And if you don't pour rain on them in the right time, then they're not going to yield as well. And you can have soybean plants that look terrible. And if you pour rain on them, they're going to yield great. So I think it's a combination of maybe a little bit shorter and weaker La Nina. The range of outcomes doesn't look as bad to me as I think some people are expecting. And then we just grew a crop in really, really dry conditions in the US that would have been a record not very long ago.
Okay, thanks, Tori. Can you go over a little bit about the barriers to increasing soy crush capacity?
So the biggest barrier, there's a couple of barriers, I suppose. One is that the ABCDs really run the industry, right? And so starting up as a small crusher is probably has unique challenges just because you're a small crusher in an industry dominated by four really, really large multinational companies. Beyond that, it's a construction project that, while not the most complex thing that you can construct, it's also not a house. And so it's not like you can throw up a soybean crushing plant in 6 months or something like that. There's a fair amount of permitting that needs to be done because you're using some pretty nasty chemicals to crush soybeans. And so the process just takes a little while. I'm not saying that it's impossible. And like I said, in my balance sheets right now, I've got 2.3 billion pounds as the crush for 21, 22. So I'm kind of betting on that expansion. But it's also not a given that we're going to get there, I don't think. Beyond that, the other thing that I would kind of say is that beyond the crushing capacity, another potential bottleneck is refining capacity. So it's all well and good to crush the soybeans and produce crude soybean oil, but then in most cases you need to refine it further for biodiesel or renewable diesel production, and there may be a bottleneck at that level too. And then again, you run into sort of those same constraints trying to put up a refiner. Although you can do them both at once, or you can put them on the front end of a biodiesel or renewable diesel plant. All of those things are possible, but they are challenges. And at a time when we just don't have a bunch of extra supply laying around, any challenge could potentially drive prices substantially higher.
Okay. Tori, where are the next renewable diesel plants that will come online in 2021 in the United States?
The next ones I would have to look at our list. And
That would be in
it,
the Outlook report, wouldn't it?
it
Mhm.
absolutely would be in the Outlook report. In general, you have kind of two areas where renewable diesel production is expanding. One, you have plants in the West Coast area because of they can take advantage of the low carbon fuel standard credits, and that makes them wildly more profitable. And then the other area that you have expansion is generally in the Midwest, where obviously you have much easier access to vegetable oils and fats and greases as well. So I'm not exactly certain exactly which one are up next, but like George said, in the Outlook report, we have that list in a project tracker that will give you our latest our latest expectations for where plants are going to come online and their capacities.
And we're updating that December 6th or 7th is when we'll have it out.
Yep.
Another question we got here for you is how would Canadian canola and soybean crush capacity affect U.S. markets?
So if you can increase crush capacity, you still have to grow soybeans and canola seed to crush, which I think is not a long-term problem. I think it seems maybe a little daunting given our starting point. Remember the last time we were at carryouts at this level, it took us several years to sort of climb out of that hole. Part of the reason that it's tough to climb out of that hole is because Chinese demand for soybeans continues to grow as they, one, recover from ASF, and then two, modernize their hog industry to become more soybean meal intensive. And so, even if we grow a bigger crop next year, it's likely Chinese imports are going to be larger next year. And so you kind of take away a little bit of the growth in your soybean crop just right off the top. The other part that's challenging about increasing production is farmers uh, don't necessarily look at the economics to make decisions about acreage. That's certainly a part of the equation that goes into deciding whether they're going to plant corn or soybeans. But the most important factor for any farmer is their rotation. So typically you see sort of a 50% of, or maybe a little bit more of their acreage decisions will be just driven flat by rotation. I've grown corn here for 2 years. I've got to plant soybeans. I've grown soybeans here for 3 years. I need to plant corn. And so gaining acreage becomes a little bit more difficult than just simply looking at the price. Now, all of that said, the seed producers that I've spoken with are saying that over the next 5 years, the technology in the seeds is going to make it such that having a crop like we've had this year is going to become increasingly more difficult. And I tend to believe them, again, given the fact that we grew almost a 51 bushel an acre crop at a time when it barely rained in September. So that's kind of the first step. Assuming that we do that and we get more crushing capacity, I think initially we're just going to probably need it. The crush in Canada last year for canola uh, was way above people's expectations and way above the prior record. It was like 1 million tons more than the prior record, and that's like 10% of the total. Is like they crush a little bit more than 10 million tons a year, so that's a big boost in canola crushing capacity. The demand was there. And so I think if you incrementally added on to Canadian canola crushing capacity, the demand is there right now. If you approve a pathway, if the EPA approves a pathway for canola oil for renewable diesel, then there's going to be even more demand. So I think initially, any addition in Canadian canola crush would be met with just more demand. In the US, I think that it's a little difficult again because we crush, unlike canola crushers, soybean crushers crush for soybean meal and then sort of try and figure out what to do with the oil. And so it's hard for this expansion in renewable diesel capacity to drive an expansion in crushing capacity. In order for that to happen, soybean oil prices really have to go to an extreme, which is part of the reason that we kind of expect that that may happen. Ultimately, I think that we're going to need to expand crushing capacity in the US. But it's just a question of whether that will happen soon enough and whether soybean oil prices will be able to go to a level that just on their own justify that expansion. Because again, you've got to remember, if you're crushing for oil, what you're essentially saying is that I'm going to have to give away the soybean meal or give it away at very low prices. And that's a tough thing to do because soybean meal represents essentially 60% of the value of a soybean, or almost 70% of the value of a soybean right now. So you kind of have to flip that on its head, and that just implies soybean oil prices at levels that are hard to contemplate right now.
Okay. We have two more questions here, but we have time for more if the attendees want some more questions answered. Tori, what will the tallow availability pressures in Brazil and Europe have on these markets?
I think the pressure for fats and greases is going to be constant and in essentially worldwide as this big expansion in U.S. renewable diesel production um, is realized. Uh, just because, again, for for soybean crushing, okay, potentially you can drive soybean oil to a level where you are crushing for oil. You're never going to drive tallow to a level where you're growing cows for tallow. And so there is going to be a fixed and limited by the demand for the meat supply of tallow. Tallow and other low CI feedstocks will always be favored by renewable diesel producers that are shipping into states that have LCFS-like programs. And as we see the expansion of those programs, A, to other states, and then B, to other countries, then that pressure on those low CI feedstocks is just going to increase. And so I don't ever really see a situation where we are just sort of awash in tallow and prices um, are significantly below where they are today. Maybe it happens in a very short term, or maybe there's some change in biofuel policy that causes it to happen. But if you assume that biofuel policy is going to continue on the trend that we're on now, or maybe the adoption of electric vehicles or something like that. But if you assume that we continue on the trend that we're on now, then I see all of the low CI feedstocks essentially demand outstripping supply by a wide margin for as long as you care to project.
Okay. Over the last 18 months with all the renewable diesel announcements, how many new plants are actually in the process of being built?
That is always the tricky question. So there have been over the last 3 or 4 years, I would say that there has been a an anticipation of a renewable diesel surge, and every time it's happened, either the plants have gotten pushed out or something has happened and it just hasn't ever materialized. This time, it is much more real than it has been in the past, and there are plants that are either expanding or under construction or switching over. Again, if you look at the outlook report, that'll give you a lot more detail about that. But this has been something that I guess the idea that renewable diesel is coming in a big way is an idea that's been around for a long time. It's something that people got excited about a couple of years ago, and then nothing really happened. And so since then, I think people have been a little bit cautious in assuming that the expansion in capacity was actually going to occur. All I can say is this time kind of really is different. The conversations that we have with people, the kinds of questions that we get from people are much less sort of theoretical questions than they have been in the past. Sort of in the past, you would get questions like, well, if I put a plant here, what are my best options for sourcing feedstocks? Now the kind of questions that we get are very specific and, okay, I'm going to put a plant here. Where can A, how much feedstock can I draw out of this region? B, where can I get this very specific kind of this specification of feedstock? And so it just is a change in the tone of the day-to-day stuff that we hear and the people that we deal with that makes this seem much more real than it has been in the past.
All right. Tori, where can somebody find a list of feedstocks and their associated CI levels?
On the LCFS website. So if you go to the California Air Resources Board and you dig around in there, they have a lot of information. Now, the CI levels are set based on the program. So I think CI levels vary across different programs, but at this point, I think most people are interested in what's happening under the LCFS program. But they'll have a list there, and then they also have a nice handy little spreadsheet that allows you to plug in different values for the LCFS credits and the feedstock, and will spit out a value for that feedstock based on the CI value. I would tell you exactly where it is, but it's been, I don't know, 2 years. When did we put the gross margin thing together, George? It's been
Probably
like
about
two
2 years. Yep.
years since we put that together, and so I don't remember exactly where it is, but I know that it's in there. If you dig around in the LCFS stuff, maybe start with the LCFS quarterly update. It's in that area, and you'll be able to find more information on low CI feedstocks than you want.
And Tori, we can get that link and we can put that in the email I'll send out to everybody after this, which will have this video, we'll have a PDF in there, and we'll have that link. We do not have any more questions. Tori, thank you so much for taking the time to do this. It was very thorough. Attendees, thank you for hanging in there and asking questions. And we'll have this video posted in a little bit. Thank you all. Thank you, Tori.
Yep. Thanks, George. Thanks, everybody, for coming. Really appreciate it.